Thank you, everyone. Cool. All right, so today's discussion is going to be about valuation, so valuation methodologies, primarily the DCF. So, few main topics that we're going to cover. So we're going to understand what is a DCF, what is the purpose of a DCF, and then some of the components within it. So calculating free cash flows, both from a bottoms-up perspective, also from a top-down perspective. How you actually discount those cash flows by using the WACC formula, which is the weighted average cost of capital. And then we're going to look at how to actually build out the DCF. And then also some of the sensitivity analysis that goes into building out a DCF. So, what is the purpose of a DCF? So, the purpose of a DCF ultimately is to determine the valuation of a company. How we do that is typically there's a concept of intrinsic value. So, like what a business is worth on a standalone basis as opposed to comparing it to something else. So, for example, with real estate, let's say you're looking to buy a house, right? A lot of times a house might be valued based on the neighborhood that it's in, the type of people that want to purchase it, the level of demand, right? So these are sort of external factors. So for example, if the house next to you is worth $1 million, and the house across the street is worth $1 million, this house will most likely be around that value. But with a DCF, you're looking at the actual intrinsic value, so like the actual value of the asset itself or the business itself. So, like we talked about last time in our last session, cash is king, right? So, the income statement tells you about the revenues of the business, the expenses of the business, but a lot of times these are more so accounting concepts and not necessarily real cash. But the goal of a DCF is to say, okay, if this business, right, produces cash, as it should, as any business does, it's gonna, you forecast those cash flows over a certain time frame, and then you're able to, because there's a concept of time value of money, you discount it to today's value, and that ultimately gives you the intrinsic value of the company. So there are a lot of assumptions that go into this. One being, how do you actually forecast the performance of the business? What exactly is free cash flow? So how do you forecast the free cash flows of the business? What discount factor do you use? What time period do you use to actually do the forecast? And so those are extremely important pieces. And obviously, they're intricate components of that. So yeah, I think here, so we talk about DCF, and then there are two other valuation methods. So the DCF is intrinsic value, and then the other two values, which are more external related, that we talked about, are trading comparables and then precedent transactions. So if you ever want a career in finance, in any type of transaction, like this, it's an absolute must to know these three things. Like if you don't know these three things, and if I were interviewing you, I would never hire you. You need to know what a DCF is, trading comparables, or we call them comparable comps. People use interchangeable names, and then precedent transactions. So DCF is intrinsic value, forecast, the free cash flows of the business. You discount it to the present value. Then you have trading comparables, which is saying, okay, this is like what we talked about last time. I think we touched on it a little bit, which was benchmarking. There's a company that operates in a certain industry. It might have competitors, right? What are those companies currently trading at? So once we have a stock exchange and these companies are listed, you'll be able to know what the multiples that they're trading are at. So you compare, for example, you might have a list of peers, and then what you do is you take an average or you take a median of the multiples, for example, enterprise value to EBITDA, or depending on the industry, like for example, if it's a financial services, price to book ratios, PE ratios, price to earnings ratios, right? So different ratios that you use for different industries, because different industries are valued based on different metrics. You take an average of those, and then you would apply it to the company that you're valuing. So I'll give you an example. For example, let's say the average of all the industry peers for Deloitte, let's just say enterprise value to EBITDA. That's the multiple we use to value these businesses. So we know Deloitte's EBITDA is, let's say, 1 million. Let's just make up numbers, 1 million. So Deloitte has EBITDA of 1 million, we know that for sure. The industry peers, right? You did the analysis, you look at like, let's say 5 or 6 peers, right? They're all trading on the stock exchange or wherever they're trading at let's say a multiple of, some are like 5, some are 4, some are 6, some are 7, whatever, right? You take an average of those, let's say the average is 5, so 5x, right? 5x is the multiple. What you would do is to determine Deloitte's valuation based on the comparable comps methodology is you take that multiple, 5x, and you just multiply it by the $1 million of EBITDA, if that makes sense. So 5x times 1 million is what? 5 million, right? So that's the value. That would be the value using the trading comparables. Precedent transactions is basically like if there were previous transactions that occurred, like M&A transactions, so if an investor invested in a company or acquired a company, right? They typically bought it at a price. That price comes back to ultimately a multiple, right? There were financial metrics at that time. There was a price that was paid. It's just simple division. You understand the multiple, right? And let's say you look at a bunch of transaction multiples, and then you take that average or the median, and then you apply it to the valuation of the company. So same logic. You might get, for example, 5x again. When you look at the average of previous transactions that occurred over the maybe the past 3 or 4 years in an industry, you take those multiples, the average of it. So let's say you get 5x again. So 5x times $1 million of EBITDA is 5 million. So that's how you determine valuation. In terms of the order of this, precedent transactions usually has the highest value. So that's just good to know. The reason why it has a higher value is typically people pay a higher premium when they're buying something outright, in order to entice the seller to actually purchase or to actually sell the business to the acquirer. And then trading, comparables. These are heavily affected by the market, and then of course you have your DCF, which represents the intrinsic value. So typically, businesses are usually a lot of people base the valuation on trading comparables mostly. But in a market like Ethiopia, for example, where there are not a lot of publicly traded companies, or there's not a vibrant stock market, you tend to use the DCF method to value, but all three are always used. So in any situation, you look at all three, and then you're able to triangulate the valuation. So it kind of gets you right around the same, it should get you theoretically right around the same range. And then of course, if you're doing some kind of transaction, then those things get negotiated with the buyer and seller, and then you get to a final price. So we're going to focus on the DCF piece of it. So DCF ultimately comes down to the basic principle of time value of money. So time value of money, meaning $1 today or $1 today is more valuable than $1 tomorrow, right? So what does that mean? There's a thing called inflation. You guys know what inflation is, right? You guys know what inflation is? Is anybody that doesn't know what inflation is? Good. So inflation, because for example, you might have, let's say, 1,000 birr today, right? 1,000 birr can get you, some amazing food at your favorite restaurant. A year from now, that 1,000 birr might not even get you a ride, because of inflation, right? So over time, and for even excluding inflation, the return that you can get from 1,000 birr today, for example, if you have 1,000 birr, let's say you invested it, you might be able to get a certain return, right? Versus if you actually waited, right? And let's say you just held the 1,000 birr in your bank, no interest, no nothing, no return on it, right? And then next year you try to use that 1,000 birr, all you have is 1,000 birr, right? Like there was no appreciation, you didn't make any money on it, and then ultimately, there's inflation, which tends to increase over time, so that 1,000 birr becomes less valuable. So the DCF uses that fundamental principle. $1 today is worth more than $1 tomorrow. So what does that mean? You forecast the future cash flows, and then you discount it to the present value. So meaning here are the cash flows for the next 5 years. And then in perpetuity, meaning forever, you also make an assumption. There's a methodology behind that. And then you use a discount factor to actually discount that to today, to the value of it today. And so that's the logic here. So future value of cash flows, present value of future cash flows, and then you discount it, and that gets you the valuation. So here's just an example. So if you invested $1,000 today at 6% for 3 years, the future value would just be 1,000, right? Times 1.06, so 0.6 is the percentage. You always add 1 because that's just the way you do it, and then you take to the power of 3 because for 3 years, right? That's just the simple math for compounding. I think do they have this materials?
Yeah.
Okay. So I think you have this materials, but this is just more of the logic behind how compounding works, and then discounting is obviously the reverse. So in the compounding instance, you multiplied it, and then in the discounting example, you just divide. So yeah, discrete forecast period in terms of, so we don't call it discrete forecast period, we just call it forecast period. But typically you forecast the business for the next 5 to 10 years. So I don't know if you have experience with modeling, but like when you look at financial statements, right? This year, usually the past 2 years, like in any audited financial statements, you have the past 2 years. In Ethiopia and then in other markets, usually it's the past 3 years. And so you can see, how the company has performed. And then typically what you do is you forecast. So you forecast how much revenue would grow, how much your expenses would grow, various, capital expenditures, meaning how much investment the company is making to its own business. You forecast these different factors. And usually this requires a lot of, it's much more complicated than what I'm saying. So like for example, revenue is, do you guys know what goes into revenue? Like how you calculate revenue typically in any business? Has anybody ever started a business? Have you ever operated a business? No? No one? Okay, just take a guess. How would you calculate revenue? Like let's say you have a business. How would you calculate your revenue? Price times quantity. Simple. Price times quantity. So number of orders or number of whatever you delivered or whatever it is that you offer times the price, right? That's basic math. So how you determine price, so you'd have to forecast the price, right? Over the next few years, you'd have to forecast quantity. Over the next 4 years, those two things combined will get you, revenue. And obviously, to forecast that, you also have to make assumptions about the number of customers that you're going to get. In order to get those number of customers, you're gonna have to forecast also marketing expense, right? Because you have to market to acquire customers. So all of these, and then in order to actually have good marketing, right? You also have to forecast potentially hiring, right? Because you need more employees in order to do more marketing, in order to get more customers, in order to sell more products, right? In order to get more employees, you also need additional capital, right? So you might need to invest money. So there are a lot of things. It's very intricate. You'll see it like once you guys actually start practicing modeling. So you forecast these different the financial statements for the next 5 to 10 years. 10 years is usually extreme. No one really in real life, no one forecasts 10 years. Usually 5 years is the max. Even 5 years, you're pushing it, but usually it's 5 years because after that you can't really predict, right? In quantum, 5 years from now, even 2 years from now, 1 year from now, it's very hard to predict what could happen. But you try your best to forecast for the next 5 years. And then the remaining years, we call it the terminal value. So there's a terminal value. So that's here. And so there's 2 ways to calculate a terminal value. I'm not going to go into it in detail. But there's the perpetuity or Gordon growth model or the exit multiple method. So use one of these 2 methods to determine the terminal value. You combine these 2, so the forecasted free cash flows, the terminal values, and then you discount it, which we'll get into the next page. So I think we already touched on this DCF trading. DCF trading, precedent transactions. So yeah, DCF is based on cash flows, and you discount it to the present value. Trading comparables, you use various multiples, so it could be enterprise value to revenue. So typically you use a revenue multiple for companies that are not profitable yet. So you might see in the US market, there are a lot of companies that are publicly traded that might not be profitable yet, and that's purely because there's so much growth and so much excitement about technology. So you use revenue multiples for those kind of businesses. For businesses that are profitable, you use EBITDA. So EBITDA, and the reason why you use EBITDA is EBITDA is earnings before interest, tax, depreciation, and amortization. So maybe, I don't know how they explain it to you in school, but to just make it stupid simple, EBITDA, right? So do you guys know what EBIT is? EBIT? That's just, just revenue minus COGS minus SG&A gets you to EBIT, right? Sometimes you have depreciation and amortization baked into your cost of goods sold, but we don't need to get into the technicalities of it, but pretty much EBITDA gives you a picture of what is the actual profit of the business, excluding any external factors. Primarily 2 external factors, or 3, right? One is interest. So interest is an external factor, meaning that's something that you would have to pay from if you have loans from a bank, right? Otherwise, you wouldn't pay interest. So that's one. Taxes, that's government, right? So if there were no taxes involved, or for example, you structured your business differently, there might be different taxes. I don't know how it works in Ethiopia exactly, but in different markets, there are usually ways to play the tax part. So you want to look at the business without interest taking into effect, without taxes taking into effect, and then also depreciation and amortization. So depreciation and amortization are pretty much the same thing. Depreciation is for physical asset, amortization is for intangible assets. They follow the same principle. So you want, and this is an accounting concept. So I'm sure you guys have learned about straight line depreciation, or I think what is it, double decline, whatever. So those are more of assumptions that people make, right? Because the principle is let's say you have a real estate, right, or a machine. Over time, you use the machine. Over time, that machine would decrease in value, right? Because there's wear and tear, there's some damage, there's it's being used, right? So it's not as valuable as it was when you first purchased it. So the depreciation and amortization line item is just a way to actually, sort of in an accounting or finance way, highlight that. So it's not an exact science, but so the reason why you look at EBITDA though is you want to make your comparison to another business apples to apples. So what does that mean? Another company, so you might have a lot of debt, another company might not have any debt. Another company might have a little bit of debt. Another company might have more debt. If all of these companies operate in the same industry, right? And for example, you're trying to do your trading comparables that we talked about earlier in order to determine the valuation, you want to look at the EBITDA because you want to remove those factors. Because in the event of a transaction, for example, right? Let's say if I purchase your business, when I purchase your business, enterprise value is what? Do you guys know what enterprise value is? And valuation? Have you guys gotten to that yet? So enterprise value is just the equity value of the business plus debt, or net debt. Maybe that's a little technical for right now. Again, you want to be able to see the business, excluding these external factors, because in the event of a transaction, when let's say I purchase a business, I'm going to pay off the debt, or I might refinance the debt. So I'm the new owner, so I paid off that debt that you previously had when I acquired your business, and then I might take on new debt, or I might not even take any debt. So I want to understand what the true performance of the business is, because these things can change from hand to hand. And then price to earnings. So EBITDA, yeah. So I think we touched on this a little bit. Yeah, I guess you want to jump into this?
بغض عن تدخل
So when for free cash flows, right? So in the instance of, so when we use the word free cash flows, right? There's two types of free cash flow. There's unlevered free cash flow and there's levered free cash flow. So levered free cash flow takes into account the interest payments. For example, if there's debt on a business, the interest payments that a business has to pay. So after those interest payments are paid, then how much cash is left available that is entitled to the equity investors in the business. So that's levered free cash flow. Unlevered free cash flow is, it doesn't take into consideration of interest. So it's the cash flow that's entitled to both debt and equity investors. So that's, you might need to think about that a little bit more, but that's effectively what it is, and there's different reasons why you use each. So, and then the other point I want to highlight is when you forecast unlevered free cash flow, use the WACC. So WACC is the weighted average cost of capital. That's if we talk about that, but weighted average cost of capital includes two things: cost of equity, cost of debt. So this means, for example, if a business has a ton of debt, for example, like you might have different tranches of debt, there's an interest payment on each, right? Like, so there's an interest rate, for example, on one loan that's like 6%, another loan that's whatever percent, another loan that might be a different percent, or bonds, whatever. And so you take the average of these, and then obviously it has to be weighted accordingly to the amount of debt. Let's say you calculate cost of debt, and then cost of equity is a very complicated formula, which we don't need to go into right now. But the two of these, comprise of the weighted average cost of capital, which is what you use to discount the free cash flows to the present value. You can go back to the previous page. So this is the formula. So to calculate unlevered free cash flow, it's your earnings before interest tax, which is just your operating income. It's just a fancy word, or fancy abbreviation, but it's just operating income. Times 1 minus the tax rate, because we want to look at it, because taxes you have to pay, right? And then you add back depreciation and amortization. The reason why you add back depreciation and amortization is, last time what we talked about is, or earlier what we talked about is, depreciation and amortization, it's a bookkeeping figure. So it's an accounting, it's not an actual expense. There's no cash. It's just something you show on your financial statements. So you add it back. So it's expensed on the income statement, or it's baked in somewhere, like typically cost of goods sold or an SG&A somewhere. So you add it back because there's no cash involved. So the income statement doesn't talk about cash. It talks about the accounting way of showing income, right? But it's not talking about how much cash is actually coming into the business or going out of the business. So you add back the depreciation and amortization, and then you subtract capital expenditures, because capital expenditures is, it's a cash outflow of the business. It's typically a required part of the business. And then change in net working capital. So net working capital is like your ability to, pay off your short-term, it's pretty much the liquidity of the business. So like you have obligations, right? You have to pay employees, you have to do, you have suppliers, these different things. So your ability to pay. So the difference, right? That's actual day-to-day cash that's needed. So you subtract that out as well, because that's a necessary part of the business, and that gets you to your unlevered free cash flow. So there's two ways. And by the way, you should try to memorize these formulas, because it's a very it's pretty much expected to know the formulas in the industry. So there's two ways to calculate the unlevered free cash flow. You can do it from bottoms up, so start from the net income, and then make the adjustments to get to the free cash flow. And then you can start from EBITDA. So EBITDA, you add back the D&As, whatever, and then you can make that unlevered free cash. So those are just formulas that you just have to play with and get enough repetitions in to fully understand.
We can do the border.
Hmm?
Border, we can do it here.
ish. Sorry, net income. So you'll see it. So when you guys do the examples, it'll make more sense. Some of these things it's a little bit tricky to understand just in theory. So you actually have to do exercises and then open up your computer and actually do it in Excel, and then it'll click more. So earlier what we talked about the forecasting piece. So when you're building these things in Excel, right? There's the revenue schedule. So that's what we talked about earlier, about understanding growth rates, the price times quantity, right? That's volume times price. Just understanding these different aspects. For example, a business might have multiple revenues, multiple types of product offerings, right? So it can get really, really granular depending on the type of business. So understanding how to actually forecast that is a huge, part of it, and it actually takes up a lot of time, and it's usually very heavily debated. So let's say you have a team, right? You have to justify these assumptions. You have to look at what's going on in the economy, in the country, in the market, management's expectations, and then really try to understand, how to forecast that. And then cost, same thing, right? So cost of goods sold, right? So you actually need inventory in order to generate revenue. Understand your operating expenses, SG&A, right? Selling, general, and administrative expenses. So you need staff, you need marketing, right? All of these things need to be considered because these also help drive revenue. They're also a necessary part of operating a business. And then there's fixed expenses. There's variable expenses. So you might have rent, different payments that you might have to make that are a core part of the business. And then depreciation and amortization. So that schedule in a model is also very complicated typically. So if it's a very asset-heavy business, you have to forecast the depreciation over time, and then not just forecast the depreciation, but you also it's touched here in capital expenditure. So capital expenditure and depreciation typically go hand in hand. So as an asset becomes less and less valuable because of wear and tear. So for example, it could be a machine, it could be real estate, it could be a building, whatever it is, right? You need to reinvest, right? That's what capital expenditures are. So you might need to hire a painter for whatever, or you might need to buy additional equipment as you continue to expand, or you might need to buy completely new equipment in the event, for example, that one machine or whatever it is that you have becomes completely useless. So those two things, you usually try to balance those two. You typically want your capital expenditures to, at bare minimum, equal your depreciation. Because that means you're at least replacing what's being depreciated. And it's usually a very complicated schedule because DNA applies. I mean, you can do it high level, but as you get into very complex transactions and it gets very serious and people really want to understand what exactly is going on, you might have different assets like plant, property, and equipment that for each one of those things you might need to have a depreciation schedule for each one of those, and that can get pretty complicated if it's a big business. And then the working capital schedule, right? So accounts receivable. So there might be customers who pay you on credit, right? Or you might be a vendor that sells. Like you might be a B2B business, right? So not direct to consumer, but you sell to other businesses, right? So like if you think about technology, a lot of technology businesses, that's what they do. They sell to other businesses. If you can go back to that page, so finish it. So, accounts receivable, inventory, accounts payable, right? So these things. So accounts payable meaning you might also owe money to suppliers. So suppliers might provide you a product, and you tell them you're going to pay them in 10 days or a week, 15 days, 30 days, 90 days, depending on your agreement and the level of trust you have with these vendors. So and people typically do this to manage their liquidity, right? Because you might not have enough cash today, but you might have it tomorrow, or a week later, whatever, because you have sales coming in from this. So those are schedules that also have to be understood. So earlier we talked about the WACC formula. So WACC is so cost of equity and cost of debt. the cost of debt is usually a very simple formula. It's just whatever the rate is on the debt, right? It's the average of all the interest rates. That's the cost of debt. And then cost of equity, that's where it gets complicated. So you use this thing called the capital. So capital asset pricing model. So it's actually it's very important to understand. So RE, this is like the formula. So return on equity, right? It's just the formula. RF is the risk-free rate. Plus beta times the market risk premium. So I know this sounds so technical, but so the risk-free rate. What is a risk-free rate? So typically, for example, I'm gonna use the U.S. as an example. The risk-free rate is typically the U.S. Treasury bonds, right? The reason why, so Treasury bonds meaning the bonds that the government issued. Why are those considered risk-free? They're considered risk-free because the government is going to pay, right? Like they have to pay. And at least the expectation, at least in the U.S., is that the government won't default, meaning they won't not pay, right? They'll pay. In real life, of course, there's always a risk, but that's what's used as the risk-free rate. So in the Ethiopian context, there's no real risk-free rate because the government is just now starting to issue treasury bonds and treasury bills, but it's not, it's not there yet. But ultimately, at some point, that will get used. Beta is just a fancy word, a fancy Greek letter that talks about the correlation of a stock to the overall stock market. So it's very, very. We don't need to go. I mean, it's not really relevant in the Ethiopian market because there's only I think 2 companies that are listed, so you can't even use them. You might use the beta for companies overseas. For example, let's say you're trying to value a bank here, which is what we do in real life. We would use the betas, for example, of similar companies in, let's say, Kenya, Tanzania, Uganda, and then try to make some adjustments. But that's like correlation. So what does that mean? What does correlation mean? So let's say if the overall stock market goes up, 10%, and then let's say this company's stock goes up 10% as well, that means it has a beta of 1, right? Yeah, 1. So it means like it's perfectly correlated. The lesser, then it goes down, or the more it goes, then it goes up. If that makes sense. Does that make sense? It's a little bit technical. I know this kind of stuff it's a little bit hard to understand at once. You kind of have to go home and think about it a little bit more, and you probably still won't understand it because it's just complicated. And then when I get confused sometimes. But it's it's just correlation. So for example, if the overall market, like every overall market meaning, so there are no mutual funds in Ethiopia actually. So that's the issue. Fuck it. And then market risk premium, meaning the return over, so market risk premium is pretty much like there has to be a premium over the risk-free rate that investors want, because they wouldn't necessarily invest in your business unless it was more, if there was more promise of a higher return over the risk-free rate. So does that make sense? So for example, if you could make, let's say if you could make $5 with no risk, right? Versus $5 with, let's say just make a fancy numbers, 10% risk. Which one would you choose? You choose the risk-free one, right? It's obvious. Right? Why would I take more risk, right? The only time you would take more risk is if it wasn't $5, right? If it was maybe 10 or 15, right? That's just basic, right? Like if someone said, hey, I'll give you $100 for free, or there's a 20% chance you might not get what I'm about to give you, but I'll give you $1,000, but there's a 20% chance you might not get it, or a 30% chance you might not get it. Which option would you take? you start thinking about it, right? At least you think about it. Right? It was just because $1,000 versus $100. I'll take a risk. $1,000 is 10 times more than this $100. So that's kind of the rationale, the logic, right? And like I told you guys last time, a lot of accounting, a lot of finance is just using fancy words for stuff you already know. Like you already knew that, right? If someone said, hey, there's a little bit more risk but a higher return, you're gonna do it, right? It's very, human nature, very logical. So anyways, that's the Kaplan model. You should, look it up. So that's how you calculate cost of equity. So cost of equity times cost of debt, and then the proportional amount of equity and the proportional amount of debt. That's how you calculate the WACC. So there's you guys will see it later when you go through it, but that's how you calculate the formula. Terminal value. We don't need to go into this in too much depth because it's a little technical, but this is how you calculate the terminal value. So terminal value. Remember what we said. So you forecast the future cash flows of a business, right? And you discount them to present value. But theoretically, right, you can only forecast, credibly for the next 5 years, right? Let's say even 10 years. Let's say you forecast 10 years, right? The business is probably going to exist long after that too, right? How do you have to forecast 100 years, 120 years, 150 years, 200 years? No. What you do is you calculate what's called the terminal value, which is effectively like the sum of all of the remainder of those free cash flows, and use these two methods to do so. So you can look at it a little bit later in detail, but that's the logic. So yeah, this is what we talked about earlier. So you forecast unlevered free cash flows. This, by the way, extremely important to understand. So meaning that you should, even if you don't understand it, just memorize it. Because if you ever want a career in finance, if you ever want to be an investment banker, transaction advisor, even if you have your own business, you want to understand the value of your business. It's extremely important to understand this. So you forecast free cash flows for the next 5 to 10 years. Let's just say 5 years. You calculate the terminal value, which is for the remainder years. Then you calculate a WACC, which is your discount rate, right? The weighted average cost of capital. You use that to discount the sum of those two figures, right? The forecast of the 5 years and the terminal value. You discount it to the present value. And yeah, that's your enterprise value. So yeah, so once you have your enterprise value, then there's two concepts that I kind of mentioned earlier. So enterprise value equals your equity value plus net debt. So this will make more sense as companies list on the exchange, then it'll make sense. So you can back into so when you have enterprise value, you can back into what equity value is and then what net debt is. Or you know what net debt is, but you can back into equity value. So equity value plus net debt equals enterprise value, right? Like you guys know how assets equals liabilities plus equity? It's just basic math, right? It's not fancy, it's not. So that means assets minus liabilities equals equity, right? It's just rearranging. It's just basic algebra. So same concept. Equity value plus net debt equals enterprise value. So if you get the enterprise value, then how do you calculate equity value? How would you calculate it?
You take out the debts.
You just take out the debt, exactly. It's just basic math. You just subtract. So that's the basic rationale. So net debt just means debt minus cash. The reason why you use net debt is because typically in the event of a transaction, right, there's usually you would use the cash to pay down some of the debt. So the cash that you have in the business to pay down some of the debt, and then the remainder is your net debt, and then your debt plus equity. We can go back. So when you see the stock exchange happen, right? So you'll see in the coming months there'll be additional companies that get listed, right? Which we're working on some of them as well. So shares outstanding. So there's a concept called shares outstanding, right? So that's shares outstanding is just a fancy word for the number of total shares that exist, right? The number of total shares, right, multiplied by the share price equals equity value. So this is the technical valuation of equity value, but there's also this other way of calculating equity value, which is shares outstanding times share price. So number of shares times share price equals the equity value. Then from that equity value, you just add the total debt minus cash. That gets you to your enterprise value. So why does this matter when you're doing a DCF? So the DCF will give you the enterprise value number, right? And then from there, because you know the total debt on the business, and you know the cash on the business, you can calculate net debt, and then you do enterprise value minus net debt, which gets you to the equity values. Once you have the equity value, you can divide it by the number of shares, right? When you divide it by the number of shares, what does that give you? Share price, right? Which is what you want to know. That's the purpose of the DCF. So you want to know the enterprise value, but then you also want to understand what the actual what the share price value would be based on that assumption. So how is this relevant for your stock composition? What kind of stocks are you guys looking at?
Most probably international.
International, right? So why does this matter, right? So on the market, there's an equity value, right? I just told you share price. There's a share price on the stock market, and then there's the number of shares outstanding. That gives you the equity value, right? Then you know the number of shares outstanding, right? So you just do the division, and that gets you to what? It should be the share price, right? It should be the same thing, right? So there's the share prices in the market, and then there's the analysis that you would do. So let's say you're an investment analyst or investment banker or whatever you are, right? Or just someone who just wants to, buy a good stock that's going to appreciate in value. So what you do is you do your own analysis. You make your own projections based on your own assumptions. Or you might read research. The research might tell you, oh, this company or this sector is growing at this pace, or it might not grow at this pace because of this factor, this factor, this factor, right? So you do your forecast, right? All the revenue, manaman, right? Then you do all the calculations to get to free cash flow. From there, you do your forecasting for the next 5 years, terminal value, blah, blah, blah. Discount rate, which is your WACC, right? And then you get to an equity, you get to enterprise value. From enterprise value, you know the debt on the business, right? So that's static, that doesn't change. So minus minus debt plus cash gets you to the equity value, right? Equity value. So this is your model, right? I'm not talking about the stock market. Your model. Then from the equity value, you divide it by the number of shares, right? That gets you to a price, right? Price per share, right? So what that means is, if that price that you built in your model is higher than what the market price is, right? What it's currently trading at, right? On the stock market, what does that mean? It's undervalued. Exactly. That means the market has undervalued the stock. So based on, I don't know if you guys have taken an economics class or anything like that, right? Like there's a theory, like rational markets theory, right? Which is the market will eventually, catch up, right? So right now, maybe it was overlooked. Maybe people didn't really understand the opportunity the way you understood it, because maybe you're an expert in your field. Maybe you spent hours of research, right? So you said, wait a second, this price that I got is much higher. By the way, if it's much higher, you should probably also, challenge yourself too. You should think, wait a second, did I miss something? And then just so you don't, miss something. But the way it works is, if the price that you got is higher than this price, that means this is probably a good investment. Let me buy shares, and then eventually the markets, people will also start to think about this company at some point, and then it will appreciate in value, right? Which means, for example, let's say it was the price you got is 30%, or the price that's on the market is 30% below the price you got, right? Eventually, it might even go above that price that you calculated. that means you probably made 30% or more return on your investment. So that's how it works. If the price you calculated is below, then maybe what that might indicate to you is the stock market is overvaluing. Like the more investors, global investors, are overvaluing this stock. So at some point, it's going to go down. Because markets are not always rational. Sometimes they're irrational. People just, momentum, hype, all of these things. So people just get excited. They invest into different things. So if the price is much higher on the market than the price you calculated, then you say, wait a second, I'm not going to buy this. Or if you're really aggressive, you can short the stock and make money when it comes down, because eventually it will come down if you're right. But again, this all comes down to the assumptions that you use when you're forecasting revenue, expenses, all of those things that we're talking about. So sensitivity analysis. So whenever you do any type of valuation, you also want to do sensitivity analysis. So these go hand in hand. Like it's a must. So in the first place, any model you build, you should just understand it's never correct. It's never correct. It's never 100% accurate. It's always going to be wrong. It's because, again, markets are not always rational. And number two is you can't predict the future. You just can't. You can only make your best educated guess based on research, based on industry leading, whatever, based on using your own brain, right? So what a sensitivity analysis allows you to do is just see a range. So, okay, if I forecasted revenue growth at 3%, but what would happen to the valuation if it was 2.5% or 3.5% or whatever percent? Like you just want to see these differences, and you can see what that effect is on the valuation. Same thing for EBITDA, same thing for cost. You can virtually do sensitivity analysis for everything. But ultimately, you just want to see what the impact of some of these minor changes is, and it shows it to you in a table. So I don't know, have you guys seen like what a sensitivity analysis looks like? It's just a table, like a matrix. Like on the left side, there's numbers, and the top side there's numbers, and then in the middle there's just like different things. So it just shows you like what the outcome would look like in different circumstances based on different assumptions. So yeah, common pitfalls, modeling best practices. Have you guys ever built a model? Has anyone here built a model before? No? No one? Never you tried to build a model? Operating model? No? Okay. So yeah, this might not be too valid, but yeah, I mean this is fine. We'll just skip this. The key takeaways is that DCF is intrinsic value, whereas the other two valuations are not intrinsic. So they involve market factors, right? So trading comparables and then precedent transactions. Precedent transactions talks about transactions that have actually happened in the market. Trading comparables talks about the multiples of peers. So that's where the benchmarking thing that we talked about last time was. So you have to think about who are the comps, who are the comparable companies, and then how you would actually select those peers, and then you take the median or the average of those, and then you apply that multiple to the company that you're doing your evaluation for. Terminal value, again. So all of these things, it's not going to really make sense until you read it again, and then even when you read it 2 or 3 times, you still have to actually just practice trying to build a model. And then once you do that, you start. Some of this stuff will start making sense. Like once you actually do, you say, okay, how do I forecast revenue? And I think you guys have an Excel that you go through, which will just show at a high level. But of course, the expectation is that you will become more detailed in your approach. And then typically, when you work for a firm, like say for example Deloitte or any other investment bank or these big firms, every single number you need to be able to defend it. Why did you make this assumption? Where is this coming from? Why are you projecting revenue to grow by this much? What is the breakdown? A company, a client, for example, who's asking you for a valuation might ask you, how did you come up with this? So, one thing that we experience a lot is, for example, clients might argue with us because they, why would you, your assumption is too conservative. Our management case, our belief is we're gonna grow at 20%. We're like, bro, the only thing growing at 20% is inflation. Like, it's not your business. So, you know what I'm saying? Like, you have to be able to, argue. In fact, these are very sensitive conversations. It can also become very emotional because valuation is like people look at their business like it's their baby. That's just how it works. And these are valuation, and these are, they just have very emotional attachments. Versus when you're an advisor, you have to be objective. No. The industry is not even growing at that. The only way you're going to be able to grow at that is if you literally just hijack the whole market. It's impossible. This is the assumption. This is what the research says. So you need to be able to have, and then the sensitivity analysis also helps. In the events, for example, there are some changes that might need to be made in the sensitivity analysis in those tables. You can see, okay, if the cost of capital is a little bit higher, the valuation might be a little bit lower by this much, depending on, let's say if it's you show a table, let's say 10%, 9.5, 9, 8.5, 8, right? You can see what the effect on the valuation is. You can do the same thing for revenue. The revenue growth. You can do the same thing for EBITDA growth. You can do so many different things that you can sensitize. So it's just, I think the big takeaway is understanding every single assumption. You should definitely understand those three methodologies, the pros and cons of each. That's just a basic, if you don't know it, you shouldn't even, I don't want to say too much, but that's about it. You should know that, and then you should understand what a DCF is conceptually. The easy way to explain it is you forecast free cash flows for the future, and you forecast the terminal value, calculate a WACC, use the WACC to discount that to get your enterprise value. That's the basic way. The technical way, of course, is what we talked about. Forecast free cash flows, unlevered or leveraged free cash flows, depending on what you're doing. Use the weighted average cost of capital or cost of equity, depending on what you're doing. To discount to the present value of the enterprise value. From the enterprise value, the debt, the cash position. So you calculate equity value. From the equity value, you're able to calculate the shares. You're able to determine the share price by dividing by the shares. So it's just basic math. You'll see it. You have to just do it. You're not going to remember it from what I just said, but when you see it over and over and over again and you practice it, that's how you get good at it. But yeah, that's the big thing. So understanding your assumptions, and then the other thing is making sure your model is clean. So clean meaning it's organized properly, everything flows properly, color coded. So color coded meaning typically in the industry, best practice is if you're hard coding something, meaning you're manually typing it in, that's usually in blue. If it's a calculation and it's whatever it is, you'll see it when you get into Excel. But the calculation is usually in black. If it's referenced from another sheet in the Excel, it's green. And then typically use red to just highlight just different stuff.
25.
Is that it?
Camstone. Camstone.
Yes. Is it Excel?
Yeah.
So you can this is just for you guys' reference. Next.
Does it want that?
Before we close, the other thing, so just advice, what I would say is find any publicly traded company. Right? It's easy exercise to learn more. Find any publicly traded company. I would say start off with the US company because it's much more information, much more available and clean. It'll show you 3 years historical financial statements on their financial statements. Literally, income statement, balance sheet, cash flow. Just insert it manually or copy paste it into Excel. And then what I would do is I would try to link. So income statement, balance sheet, and cash flow statement, they're all linked in a certain way. I'm sure you guys will probably have a session, maybe you already did. They're linked in a certain way. Start off with that. So I would just say, start off with learning how to link the three financial statements properly, and then forecast them for the next 5 years. So just without doing anything fancy, no need to forecast price, no need to forecast quantity. Just say revenue grows by 5% every year, just grow by 5%. Expenses grows by whatever, there's some percent, just forecast it out. Then you'll see, okay, this is how, okay, now the next question will be, how did you actually get to 5%? Where did that assumption come from? Right, so that's where you get into the nitty gritty of like, understanding the price times quantity, understanding what's embedded in the expenses, et cetera, and then once you do that, then the DCF stuff will make more sense. So that's when those are just calculations. Yeah. That's it.
Yeah. Thank you very much. He has to run meeting አለው ኤክሰርሳይሶቹን we will do it እኛው እዚህ ሆነ so let's say thank you ለታምራት thank you እስከዛ እናንተ እንትን በሉ ከዛ we will start with the interactive exercise የመጀመሪያ